Hello investors, welcome to Simpli Stocks. Today I am going to talk about some interesting businesses that are currently doing quite well. These are fast growing micro cap businesses in which many positive triggers are playing out. So today we will do an in-depth analysis of these micro caps, and we will also talk about how their recent results were and what management's future plans are. But before starting the discussion, as a standard disclaimer, this video is in no way a buy or sell recommendation on any of these businesses. And because these are very small businesses, you have to exercise even more caution in them and be very cautious with your allocation just in case they do catch your interest. Because in micro caps, as long as things are good, fine. But when things go wrong, they go wrong very fast and very horribly. So with that, let's get started. The first micro cap or penny business on our list is Sejal Glass. Sejal is in the business of making different types of glasses. And here you will see in the shareholding pattern that this is also a portfolio business of Sunil Singhania. He holds about 4.4% shareholding in this through his investment firm Abacus. You must have seen tall glass buildings or big offices. So such architectural glass used in them is manufactured by Sejal, and I have been covering Sejal for some time now. They have 4 manufacturing plants, one in UAE and the remaining 3 are here in India in Silvassa, Taloja and Erode. And these units of Taloja and Erode got added recently from the company named Glass Tech Industries that they had acquired some time back. Now, due to the UAE plant, 70% of their business comes from outside India. And for that reason, you will see how volatile this stock has been. Because due to the war, the market thought that their results would turn out to be very bad. The stock had become half in value. But surprisingly, the UAE operations remained stable and production in India turned out to be well. So their March quarter results were actually good. So because of this, it recovered very well and very quickly. But you don't have to mind this rally and do not think that opportunity is over here. Because see, during such uncertainty, we did not have any information on how much the business was affected and how long the war would last. So entering a microcap business at such heightened uncertainty did not make sense anyway, right? Neither you nor I had any information whatsoever about how the company UAE business was doing. Better way to look at it is that stock fell and came back up to its old levels. That's all. It could be an opportunity, but it is also fine if we missed it. And now, as we will talk further, you will see that there is still plenty of good opportunity over here. Now, let us quickly look at their results, then we will move ahead. So, in the 3 months of January to March, their sales grew by a massive 72% compared to the last year. A very good margin expansion was seen. The EBITDA margin increased from 14.5 to 17.5%. So there is clear operating leverage which is playing out, and in manufacturing businesses, this very operating leverage becomes the holy grail which creates a lot of value. And then you will see the net profit grew by 200%, meaning it tripled almost to reach 11.4 CR. Similarly, for the full year, their sales grew by 64% year on year and EBITDA growth was 88% due to margin expansion. And for the full year, the profit stood at 29 crore rupees at an EBITDA margin of 16.5%. And what makes Sejal interesting is that their management has talked about taking this FY26 EBITDA margin from 16.5 to 18% this year. Margins could have been better, but due to restrictions placed on commercial gas because of the war, raw glass has become expensive. So gas is used in the furnace to make glass. Now they are passing most about 80% of the cost pressure. However, they did have to take a little hit. So that is why the margins are somewhat, I'll say very little, they are affected. But in spite of that, see this margin expansion that has happened in FY26 and whatever management is guiding for FY27, that is very, very good. That itself will bring pretty good growth to the bottom line. And now as the war is de-escalating, who knows that their margins might actually get better from October onwards. And there are 2 reasons behind this margin expansion. One is that they are working on high margin value added products like fireproof, bulletproof and digital print glasses. Like these fireproof glasses are used in data centers. And the second is what I mentioned, that they are getting the benefit of operating leverage. And the value added products will have a 5 to 7% share in their sales this year, not much. But next year, this will increase to 15 to 20%. So we have a good visibility of expansion in the bottom line. Now, management has given a somewhat broad guidance of 25 to 40% sales growth for this year, keeping into account the uncertainty caused by the war. But I feel they will manage to do 30% at least. And then there is a scope of 1 to 2% EBITDA margin expansion. Therefore, if we take an estimated 25 to 40% sales growth guidance for this year, the revenue can turn out to be about 500 crore rupees. And at 9% net profit margin, Sejal can manage to deliver a profit of 45 CR approx for this year, which gives it a PE of just 20 on a forward basis. So the valuation is definitely good. You can look at this business. And with the India business growing, the dependency on US will decrease. So next year, they are looking at an equal 50% contribution from the both Middle East and India to the total sales. And I was seeing that their management also recently mentioned in an interview on NDTV that after Glasstec, they are now thinking of acquiring another company, which will set the base for future growth. So work is going on there. Furthermore, the company has been paying off its debt. So overall, Sejal is a it is a good business in a good position. And what's more, that no as such major problem has occurred for them in UAE regarding payments from their customers or clients. So payments are also coming there on time. So everything is well settled, not any problem as such. And from a long-term perspective, demand is also good in both the markets, the UAE and India. Real estate and infrastructure development is happening rapidly, and GCCs are also coming, or basically foreign companies are setting up their offices in UAE and India. So there is good commercial demand. Now, moving forward, the second business that we will cover is Yash Highvoltage. I have been tracking this business also for a long time now. Yash Highvoltage is a transformer ancillary business, meaning they make a certain part that goes into transformers. And to be precise, Yash manufactures bushings. Like if you have ever noticed a transformer, you must have seen such parts that come out. These are called bushings, and through them current enters and exits from the transformer. So bushings basically provide a safe passage for the current and ensure that the current does not spread to other critical parts like core or body of the transformer and it damages them. So bushings make sure that doesn't happen. Now in any transformer, the cost of bushings is approximately 5%. Therefore, Yash Highvoltage becomes a proxy bet for us on the transformer sector, that as the transformer sector grows, this business will also grow and will do well accordingly. And after all, we have been hearing that with the arrival of data centers and green energy, etc., the transformers are also in high demand right now. So that strong tailwind is also there in the sector. And see, bushings is a moated segment with a strong entry barrier. Moated because power companies do not approve new suppliers easily. A transformer, as you know, because it is a critical product, right? So whoever their trusted suppliers are, or the players that have been there for a long time, or older companies in the market, only they get the orders. Plus, very few players operate in this market. For example, Hitachi, Trench and General Electric control approximately 80% of the global market. And if we talk about the Indian market, Yash Highvoltage competes with the likes of CG Power, BHEL, MIM and Telk. In this, TARIL is also bringing its own bushing capacity, but you see, right, there are barely 5 to 6 players even in the domestic market. And my preference is always to study those companies that have some kind of moat or a strategic advantage. And Yash Highvoltage, I can confidently say, meets all of these parameters. Now, right now, they have expertise to make bushings for small transformers up to 245 kV. But in the future, they will be making bushings for large transformers also up to 550 kV as well. And they are doing capex for that, which will be completed by the end of this year. Now, let us look at their results. So, Yash Highvoltage, it is an SME company. So, their results come twice a year in H2, meaning in the 6 months of October to March. Their sales grew by 46% compared to the last year to reach 135.5 crore. In the same direction, their EBITDA has also grown by 60%. H2 is usually always better or good for transformer businesses. So their margins have also come out well. Their EBITDA margin came in at 27.4%, up from 25%. And due to this, the net profit grew by 58% compared to the last year. The net profit for 6 months because of this has become 24 CR. As for the full year, their margins have been 25.7%. Now in H1, their sales growth was 76%. So therefore, if you look at it normally, it will look like a slowdown in H2. But overall, on a full, I'll say, financial year basis, the results have been good. In FY26, this I have already told, the EBITDA margin stood at 25.7%. And their guidance will be to maintain the margin around 25% for this year. Apart from this, growth wise, yes, they are very bullish. The management talks about growing at at least 40-45% CAGR for the next 5-6 years. So you can catch the confidence and clarity in the tone. And there is a strong tailwind in the sector as well, which I have explained. So personally, I myself had a slight doubt regarding their results, because as these bushings are made in furnace, therefore I was not sure about the margins. But management said that they have been able to increase the prices of their products without any cost, or sorry, without any trouble. So as such, there is no pressure on margins because of the raw material price increase. And the main reason for this is that bushings market itself, it is in short supply. So the company is getting advantage of that. Demand is high and there is not that much supply of bushings. So that is a very positive thing working in Yash's favor, so that they are able to pass on the costs easily. And the market is also slowly shifting to RIP bushings. So that is another thing that is playing out here. Resin impregnated paper bushings, the RIP ones, they carry high margins. And you will be surprised to know that 95% of RIP cores are currently imported into India from outside. But Yash, it is bringing its own capacity. After that, they will be even targeting exports to the USA, Europe, and Middle East. So the company will turn from being an importer to an exporter. In such a scenario, going forward, yes, margins will get better because margins are better in exports, and plus there will be benefit of backward integration. So all in all, we will get to see good margin expansion along with the growth in top line in this business. Now, right now, they have a capacity to manufacture 9 to 10,000 bushings every year, which is being increased to 15,000 units very soon in the near future. And in that, they are targeting 65% capacity utilization for this year. What's more, the fundamentals of Yash Highvoltage are also quite good. Like their debt to equity ratio is just 0.2. And in FY26, the company's ROE was 22.5% and ROCE was 25%. And as I told you that they will be exporting RIP bushings in the future. So we will see margin expansion also going forward. Now, because of all this, Yash valuation might look a bit premium to you, especially after the recent run-up. The business has come to trade at a PE of 65, I think 60, 65 the last time I saw it. But you must see the growth also that is coming in this business. And actually the entire power equipment sector is doing quite well right now. From CG power to quality power, you will see how fast orders are coming on everyone's books right now. Like everywhere orders are being allocated. Now, previously they had given a guidance of growing at 35% CAGR rate. So that also has been increased. So they have increased the growth guidance. So that bullishness is there, that clarity in management, that growth in the sector, the strong tailwind. Plus margin expansion is also a trigger here, which we will get to see from next year. So Yash Highvoltage is definitely a high growth proxy business that you can study yourself by once. And they have also recently made arrangements for a fundraise via a mix of preferential shares and warrants from the market. They will be raising 151 crore rupees, which will be used for this upcoming RIP bushing capacity. So I'll say all in all, this is a good business to track. Now a humble request just before moving forward, if you are liking this video so far, do please give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week, because honestly your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, please subscribe to our channel as well. Coming back to our discussion, the next business that we will study is Tembo Global Industries. Tembo is an interesting business where we are seeing the product mix change. They have been in the low margin textiles business until now, but now they are entering into high margin engineering products, defense and solar sectors. Like in FY26, meaning last year, textile products had an approximately 40% share in sales, and this year they are expecting just 10% business from textiles. 75% contribution will come from engineering products and services, and the rest of the solar and defense businesses, they will contribute for the rest of the income or top line. Now in the solar business, they had acquired 28 sites, out of which 7 to 8 solar plants will start within the next 2 to 3 months. The rest will start in the next 6 to 7 months. So as for the defense business, we will talk about it in detail. Now before that, first let us look at their results. So in the March quarter, you will see their sales grew by 26% compared to the last year to reach 346 crore rupees. Margin expansion was also there. The EBITDA margin grew from 10.5 to 11.3%. At PAT level, margins have improved even more. You will see the company is getting the benefit of operating leverage. Now here, although Q4 will look slightly dull to you, but on a full year basis, if you see, they have matched their guidance very well. Tembo earlier had given a top line guidance of 800 crore rupees, but then they increased that to 1100 crore rupees. And here you will see that they have managed to do 1090 crore rupees in FY26, and the PAT margin came in at 9%. On this, the management is targeting 10% PAT margin with 30 to 40% sales growth for this year, that is FY27. But then an obvious question will come to your mind, right? That when everything is so good, why has Tembo corrected so much? Like if you will see, it has corrected about 35% from its all-time high of 905 rupees and is currently available at a PE of 11 to 12. And the reason behind this is that their defense business has been delayed by almost one complete year. The sales and profits that they were expecting this year in FY27, they are now talking about all of that for next year, that is FY28. Now, although the engineering division in itself is doing well, but market had high expectations from this defense segment. And right now, the market is unable to trust again, right? What if this defense segment gets delayed again? But if it starts even, let us say, by the end of this year, according to the updated timeline, even then it can help to create a lot of value, because they had already received manufacturing license for small arms when we covered Tembo last time. The small arms category includes pistols, revolvers, rifles, all of these. And now recently in April, their license for ammunition, or basically bullets, that has also been approved. And margin will be very good in this defense business as per the management, around 30% at the PAT level, and next year it can generate at least 120 crore rupees bottom line on 400 crore sales, meaning that just with the arrival of this defense division, their bottom line can double at the company level. But we have to keep monitoring that. At a PE of 10, 11 now, obviously there is a lot of upside, and downside is quite protected, but we have to track the business with time. Apart from that, as for the biggest division, that is engineering products and solutions, their new manufacturing plant had started and they are doing well over there. They have received a big order of 300 crore rupees in Kuwait. Before that, there was the Adani order, which we discussed in the last coverage. Now, EPC order book is definitely strong, and there have been multiple order wins. And in the engineering division, just to brief you, Tembo takes up different types of EPC projects, like it takes different kinds of EPC projects across marine, ports, oil and gas, etc. sectors. And it also has the manufacturing capacity for iron and steel products which are used in these sectors, in these projects. And this capacity was recently increased also. The capacity has gone straight from 18,000 metric tons to 118,000 metric tons, and it is being ramped up slowly. So Tembo also looks like an interesting undervalued business. Yes, after Q2, I think from October onwards, things will, they will get into track, because there will be more surety as the commencement date of this defense plant, it will come closer. So we need to see how well that happens. No need to rush for now, I'll say. But yes, there are many obviously positive triggers which are playing out here, from margin expansion to their defense business. So you can look at it once. Now, at last, the fourth and final business that we will study is EV two-wheeler player Zelio. Now, Zelio operates in the sub 50,000 rupees category, in which they sell low power, low speed EV scooters in mainly tier 2 and tier 3 markets. And Zelio's proposition is that the customer buys an EV according to their daily requirement, because not everyone needs 1.5 lakh rupees new scooter, nor everyone can afford it, right? For example, let's say if someone just has a short daily commute to the office, or let's say a student who just needs a scooty to go to school and tuitions. So Zelio has designed its portfolio around these very use cases. They have even a range of two-wheelers less than 25 kilometer per hour speed, for which registrations and license are not required. And this low speed segment is largely unorganized in nature. There are many small players in different states, but Zelio is emerging as a branded organized player in this category at the, let's say, pan-India level. Last year, a total of 19.5 about lakh EVs were sold in India, out of which, mind you, 8 lakh were low speed EVs. If the market grows by 15 to 20% this year, there will be sales of 11 to 12 lakh two-wheelers which are of slow speed. Here, Zelio sold more than 70,000 units last year, and this year they are growing by 75 to 80%. That is what they are targeting, and they are targeting to sell 1,25,000 EV two-wheelers. So, if they are able to do this, then Zelio will start commanding 10% market share in this segment. Now, that is about the company and sector. As for the manufacturing setup, their new plant was started in February recently. Now, altogether, Zelio has a pan-India manufacturing base. It has a plant in Haryana, in central India, in Patan of Gujarat, then here in Cuttack, Odisha, and in Coimbatore in the south. So, this diversification will help them to save on logistics costs, because now they have presence pan-India. And for all of this put together, they have reached manufacturing capacity of 240,000 EVs. In this, 24,000 units is EV three-wheeler capacity, for which they have built a separate team, so that their focus does not shift away from the main two-wheeler EV business. Furthermore, their results have also been good. You will see here that sales grew by 76% compared to the last year. EBIT grew by 62%, and 81% growth was seen in the net profit. So these are very good numbers. The management has met its guidance for the last year. And in this, I'll say there was also a little bit push from the rumors that spread regarding petrol shortage due to the Iran-US war. But anyways, so that is it. Their results were good, and the growth guidance for this year, that is also good. Now, their target, as I told you, will be for 75 to 80% growth. Although there is somewhat risk, very little risk, that H1 can go slightly weak, because as I told you, Zelio is focused more on tier 2 and rural markets, right? And due to the El Nino wave that is coming and that is ongoing, monsoons can be delayed, or most likely they will be delayed. So because of that, your rural demand, that can get delayed a little bit. So you have to be watchful of that. You will get to see. But I'll say the long-term outlook for the EV space is definitely quite strong. And you would remember about 2 years ago, there was the first wave of EVs. Then there was also a little bit temporary stress. But now this segment is booming again. The first wave of adoption that came was subsidy-led, but now subsidies have reduced significantly, or they have been, let's say, completely removed. Now, proper actual real demand is coming, and that too on a mass scale. So the market has started to emerge from its early stages and is becoming mature. And Zelio, I'll say, even at such a small scale with such fast growth, has become profitable, whereas you will see that all other players have remained in losses. So it is a good business that you can track. Lastly, if you like this video, then do give me a thumbs up, and you can also subscribe to our channel Simpli Stocks. You will agree that all these micro caps are very special within the micro cap universe, and it takes a lot of time and effort to research and study these businesses. So if you support us through your likes and subscriptions, we will be able to bring more such businesses and more such videos for you. So with this, I'll see you in the next video. Happy investing.